Okay. All right, so let's edit. 1, 2, 3. All right. Hi, and welcome to today's webinar. I'm your host. I'm Giovanni Betancourt. Today, what we are going to be looking at, we're going to be taking a look at the VIX, obviously breadth, some short-term patterns, and we're going to be looking at what all this means in May. The old saying, sell in May and go away. All right. First of all, let's take a look at some of the Vantage disclaimers. So basically, the information, context, opinions which are expressed in the presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Vantage does not guarantee the accuracy or reliability of the information provided here. All right, so what are we going to look at again today? So we're going to go over the adage, market breadth, VIX, short-term patterns, and market sentiment. All right, so very quickly about Vantage. Well, Vantage is a global multi-asset broker. All right, we have more than 1,000 instruments, more than 100 chart patterns, and 100+ technical indicators. We trade Forex, CFDs, CFDs, shares CFDs. What we stand for: lightning fast execution, award-winning 24-hour support, global connectivity, intuitive tools. All right, so let's begin. The adage. So the adage was actually established back in 1945. It originates in London's financial district, and the original phrase was "Sell in May and go away, come back on St. Laggers Day," with the latter event referring to a horse race. Now, the day to come back will have been in September, which is when the race takes place. Now, why do I name it, or why the title around this "Sell in May and go away"? Well, let's all talk about what we are, we're speculators, and obviously we want to have a fundamental analysis or technical analysis, and so therefore the technical analyst must assess a market's internal strength in addition to gauging the attitudes of its participants. And the analyst assess whether the internal strength of each market is improving or declining by examining data that is only unique to that market. All right. So in today's webinar, we look at how market data, like the number of stocks advancing and declining, the positioning of the averages in relation to the moving averages. These metrics aid in evaluating the fundamentals of the stock market. All right. So let's take a look at what we're going to be looking at today. We're going to be talking about market strength, which is more of talking about market breadth. Okay, and that type of analysis. So it's another form of consensus type of analysis. It's another form of consensus type indicator, but this time looking at the constituents or the members of an index. So you could look at the members of the S&P 400, the 500 shares companies. What can we glean from? What's happening to all of them together as a group? Or maybe it's all the shares on the NYSE. So there are a couple of common couple of groups are common, and you can do this on any index around the world or any stock market around the world. All right, so let's take a look at basically what market breadth is. So the basic idea, the idea of breadth, the most simplest form is the advanced decline, which we'll talk about in a couple of slides. But what we're doing is looking at every day, okay? And we are talking about, we're taking all of the stocks of the New York Stock Exchange and saying how many of those close higher than what they were yesterday. Okay, we count that, and they are our advances. So we sum up how many that is. Then we take how many actually close lower, and they are our decliners. And then we can just basically just take a subtraction between the two, the advancers subtract the decliners, and that is our simple breadth measure. As simple as that. Now, obviously, as you continue, as you start doing this, you will create a history, and you can connect the dots with a line, and you'll have the tendency, you have a trend line. All right. So by doing this, okay, we also want to be looking for confirmation. So when let's say when we see that the S&P 500 and it's rising, we want to know that it's well supported across the whole market. And so that's what we want to see our breadth measure rising as well. Now, when you get to the end of a trend and the public's coming in, the public typically buys into the big house names, that they're not buying the smaller obscure companies, the big ones, the Intel, the Apple ones. They always do better than the small companies. Today event, Nvidia just happened to pop, pop out of nowhere and making this big boom, being now the third or fourth company to be valued at $1 trillion company. So those things happen, and they move the indices. So that's what you want to be looking for. Okay, that's one thing that you want to watch for. Now, when you get that situation where there's only a handful of really large capitalized companies that are rising and they're not pulling up the S&P 500 with it, but the majority of smaller cap or the smaller companies are falling away, then that tells us that there is weakness in the market, and quite often it happens around market tops. Now, often this relationship is presented as a percentage. Often, again, we're looking for these divergences. We're going to talk about divergences in this session. So also an increase in the index while more constituents are declining should generate concern that the increase is poorly supported. And so we've got a bit of a way to look at this. Okay, in this is your S&P 500 chart, and each cloudy circle here shows you that this is where the May of the year was. So this is 2022, this is 21, this is 2019. Okay, so we have a table here that says, basically when you see that breadth is rising and prices are rising, you should say the breadth is confirming the price rise. And basically when the breadth is falling and the price is falling, then breadth is confirming the price drop. But when you see breadth falling but price rising, then you've got divergence, negative divergence, and breadth does not support that. So what is happening in the price of index? And then obviously when breadth is rising but the price is falling, it's showing that breadth doesn't confirm the price drop. And again, both those cases, we will expect to reverse or to the reverse to be imminent. So we want to be looking for those things. So what we're looking for? We're looking for divergence, right? That's what we're looking for, divergence. But what is divergence? Well, divergence, the most important big technical concept for confirmation of a trend is called divergence. So as long as an indicator, especially one that measures the rate of change of price or other data, which is called momentum, corresponds with the price trend, the indicator is said to confirm the price trend. So when an indicator or oscillator fails to confirm the trend, it is called a negative divergence or positive divergence. Now, depending on whether peaks or bottoms, right? So if it peaks, there's a negative divergence, bottom, there's a positive divergence. So now, if we fail to confirm price, then obviously price could peak and bottom. Now, a divergence is an early warning of a potential trend change. It means that the analyst must watch the price data more closely than when the indicators and oscillators are confirming new highs and lows. And divergent analysis is used between almost all indicators and prices. And the divergence can occur more than one time before a price reversal. And another indicator that is widely used is the MACD indicator. All right. So although a negative divergence signals a market top, a primary stock market top can occur without a divergence. So in other words, a breadth divergence is not necessary for market peak. Now, so just to, again, to confirm divergence and confirmation, we have these cases here. This case here will be a negative divergence, we call it bullish, a bearish negative divergence. So in this case right here, in this case, the indicators are showing the perspective. Indicator showing that that's our interpretation. In this case, will be positive because we have a positive divergence. The price and indicator are showing us that, right? So the other part, confirmation, the other part is that we will call this a bullish confirmation. The price measure is confirming what we're seeing in price. And then there is the bearish confirmation. The price measure is confirming what we're seeing in price as well. So you want to, obviously, in confirmation, you want to be able to see price and price the same direction. So that's our way to confirm. Now, there was also another application of divergence where you have double divergence, and that will mean you want to see double. Here price made a peak, here the indicator oscillator made another low. So that's the first one. Then price made another high, while the indicator oscillator made another low. So in this one, there's a special double indicator confirmation, but this will be used more as at the end because obviously the indicators are lagging indicators. So you could be late to the party, but it could be a very good way to confirm that the price reversal is occurring. So that's just one way to also to do that. Now, let's just keep in mind that that the knowledge of a wide array of technical indicators does not make an analyst valuable or cause them to profit, but knowing when to apply which indicator does. So when looking at indicators, the analyst is generally looking for confirmation or divergence, right? Confirmation occurs when prices are rising and these indicators rise as well. So seeing only strong market internals. So confirmation also occurs when the falling prices are accompanied by an indication of weak market internals. So in other words, confirmation occurs when price movement and market internals appear to agree. When a market indicator does not support the direction of price movement, the analyst has a strong warning that the trend may be in the process of reversing. So this lack of confirmation is referred to as a divergence. Now, one quick example of an indicator besides the MACD is called the ROC, rate of change indicator, which is merely a plot of the ratio or difference between today's closing price and the closing price at some specified time in the past, such as 20 days. And we have that here. This is the ROC in the bottom, this indicator right here. All right. So let's say, for example, you use a 20-day ROC, right? And the market is hitting a new high, and the 20-day ROC is hitting a new high. We have a confirmation of the price action. So should the ROC not be hitting a new high at the same time as the market or stock, we have a negative divergence, a warning that the upward momentum in price is slowing down. So basically, that's what we're seeing in this case. We see that, we see here that price has, that the oscillator's peaked, but price hasn't. So that was an indication of the reversal, and then we have movement downward. Right. Okay. Now, so what do we want to be able to know about the breadth and that? So you have an understanding that if you're confirming that the price is about to reverse, right? Then you want to catch that information in the market where you'd be able to catch trades, make some money. One way for you to come and use breadth, which we're talking about the stocks and all that will be in the S&P 500, which obviously is an index that follows and trades the best 500 companies in the stock exchange. So we have the S&P, and from the S&P, there was something created by the VIX, and the VIX is the implied volatility of the S&P 500 market. So it was born out of a concept by Dr. Robert Whaley in 1993. And he was using derivatives on market volatility for hedging tools. And then eventually the CBOE, which is the Chicago Board of Options Exchange, and Goldman Sachs developed the VIX based on his work. So then initially the VIX was basically based on the S&P 100. You had the most trading volume at that given time. Then move on to the S&P 500, and we consider it the benchmark of performance in the markets. And that's what the VIX is measuring. But also some brokers and traders refer to it as the fear measurement, the fear gauge, if you will. So the VIX, which is an indicator of the 30-day implied volatility, how they determine it is through options activity. So all these volatility figures are expressed as annualized numbers. Okay, annualized numbers in this volatility of this VIX volatility index, right? So this is simply a options notebook, quotation board. So when you look at an option, okay, you're going to see that you have bid, you have the ask, right? That when you put the equities and future markets, and when there is basically an option writer, which is the seller, right? And he's asking an amount of money for it, then you're gonna have people who want to buy that, and they're gonna be bidding beneath, and you've got this spread, between them, the spread between the bid and the ask. So calculating the risk, the price used is the midpoint of the bid ask spread. So in this bid ask spread is basically 0.25. The spread, the ask is 41.44.75, and the bid is 41.50. So the spread is 0.25. So the midpoint of 0.25 will be 0.255. And then they look at the of the bid as a spread of the relevant at the money and out of the money trade options. And if you understood option, then you're not, what I'm trying to say. But basically, what they're doing is that they grab all of that information, and then they come out and they create their own an option based on that fluctuation, based on that volume that's created by people buying options in the S&P 500 at the money and out of the money, because they're the strategies to make sure that you don't lose money when you trade options, doing some strategic buying and selling options. But there's a lot of volume, it's a lot of volatility. That's why it's used. So the contracts used are the S&P 500 options that expire anywhere from 8 to the next 2 expiries, and they mostly expire around the 3rd week, sometimes on a Friday. And so as we get within the 8 days of expiry, because there's so much liquidation going on and things that could give false readings, they won't go shorter than 8 days. So from all of those options, a synthetic at the money option that expires in exactly 30 days is used. So there's the time waiting going on weighting averages, that the type of thing to create this one synthetic option, and the VIX is the implied volatility of that synthetic option. And that's how we get that number to that number of the VIX. Now we can obviously go into a lot of detail, but we don't trade options anyhow. So the implications of a rising or falling VIX index is that there is an inverse relationship between implied volatility, demand for put options, and the direction of the S&P 500. So you can understand why the demand for put options, people wanting to buy put options. When you trade options, you have 2 ways to go about it. Either you buy a call or a put. A call means that you're betting that the market will go up, or you buy a put, you're betting that the market will drop. And then you have the other way. Obviously, you can also be the seller of those calls and those puts, so you receive the premium of what they were bought. So if there's a demand for puts, people are wanting to buy puts, is because they're long in their positioning and they want to cover most of of the exposure by buying puts. If the market falls, then those puts will cover some of that loss. So if you see an increment in demand for those options, put options, then it's because people are betting that the S&P 500 will drop. So some argue that price leads volatility rather than the other way around. But let's see what happens. So looking at the chart, this one right here, you'll see a drop in the S&P 500 before you see a spike in the implied volatility, right, on the VIX. So it's a reactionary thing. A move down in price is going to be a move up in implied volatility, and you can see how that continues. So we see that the blue line spiked and the VIX dropped, the S&P dropped, the VIX rose, and then the S&P rose and the VIX dropped. So you can see that relationship. So that's why it's important for you to follow this, so you could be on the right side of the trade. So we have different ways to come about and do some calculations, because what good is that this going to tell us that, okay, so it's dropping, but how do we monetize that? How do we come about and help us find entries and exits? So basically we'll start with knowing and understanding that a rising VIX, which means increased demand for put options hedging on the underlying index, which will drive up volatility. So therefore, a rise in VIX coincides with a falling market and vice versa. So the calculations that we're gonna be able to do, we want to do a 30-day movement. What we'll be doing is we're gonna be grabbing the VIX, right? We're gonna be grabbing the VIX, the number that you see on the chart, then divided by the square root of 12. So as example, 20%. Then so we say that the VIX is in an annual volatility, so we need to convert the relationship between annual and days, so 30 days, 1 month, which is 1:12. So for the 1-day price movement, the calculation, the formula would be the VIX divided by square root of 252 days, and therefore that will be 16. So we do 20% divided by 16, it'll be 1.26 of movement, of price movement that you can anticipate in the VIX. And if you do it for a 30-day price movement, then you have that 20% divided by the square root of 12, which is 3.46. So you have to say 20% divided by 3.46, and that will give you 5.77 a market move within the next 30 days. So you have there a way for you to calculate how much of that inverted relationship between the VIX and the S&P you can capture the movement with this formula. So you could also help yourself, obviously, with if you have different, although these things happen, you have confirmation, right, that we are at the market top, and you're seeing that it is a negative, so therefore market most likely will drop, right? So if you're seeing that, and then you're seeing that the VIX is moving towards higher than 20, so you tell yourself, okay, there's a lot of volatility, there's a lot of fear. That's why it's called fear gauge, that the market will drop because the VIX is moving higher. So then you want to be able to find some short patterns that will help you put it all together and see, okay, I'll at least have 3 bar checks to go for. So I'll have first the confirmation that the market is about to make a top, do a divergence, right? And second, we have a rising VIX. So third, we're going to use a short-term pattern. But before that, I'll leave you with this information here, which is basically the different indices and the tickers that they're also, there's also, besides the VIX being for the S&P, you have the VXD for the Dow Jones, the VXN for the NASDAQ, the RVX for the Russell, the BXO for the S&P 500, the original one, and the QQV for the Americas Triple Q's Volatility Index. And there's also an inverted relationship between the Qs and the NASDAQ. I'll leave that there for you. All right, so talking about short patterns, and The basis for short-term pattern is to anticipate a sudden move, which is basically similar to the breakout concept in larger patterns. And so we're seeing divergence, confirmation, and we're seeing that the VIX is rising. We want to be able to see if there's going to be a breakout, and we see that in a sharp pattern. Then we have 3 BSs. Go for it, right? At least that's just one way to look at things. So going back to take advantage of a period when prices have reached and motion extreme, or to enter into a trend at an advantageous price as on a pullback or throwback, there are methods usually and have what has been called a setup. A setup occurs when certain factors needed to establish a pattern have occurred, and the traders are waiting for the action signal to occur. Because short-term patterns are relatively frequent and usually depend on the previous trend as well as other factors, the parameters must be known before short-term patterns can be used. So we are in an uptrend, and we see divergence, we see confirmation, we see the VIX rising, and we see a short-term pattern being formed. Then we gotta take a short position, right? So a top pattern in a downward trend is obviously meaningless, for instance, and thus all top patterns can be disregarded from consideration during a declining trend. So this leaves only bottoming patterns to consider during a downward trend. Also, a downward trend reversal pattern should only be considered necessary when prices are some kind of a support level or resistance. So looking at what we have in front of us, some history of the Japanese candlestick charting. Very quickly, this was created by a rice future trader, a legendary person named Munishina Homa, who made a fortune made trading rice, the price of rice, and then in the 1700s in Dojima Rice Exchange in Osaka, which the exchange went to be called Edo, which is now Tokyo. So there's a lot of history behind that, and they say that the guy did 100 consecutive winning trades. That's why they were so popular. But what we can see in today's world, how we can apply this to our trading, is that there are some principal things about candles. One of the principal things is that the prices seem to jump off the page on the candle chart. It presents a stereoscopic view of the market as it pushes the flat 2-dimensional bar into almost a 3-dimensional aspect, as you see here in this bar. So candles charts are visually stimulating. So we have in front of a bullish candle, and the rectangular section of the candle is called the body, right? The body represents the difference between the sections open and close. So this is a body. It is a black candle, black body, representing the price went higher. So it opened below and it closed higher. Then the wicks at each extreme represents how the difference between the sections open and close. It represents how far. That's what we call as the range of the movement of that session, by using the wicks, the high wick and the low wick, and we call that the range. So as you can see, you can tell who is in control during that session. If we have a black candle, it'll be the bulls. Then we have a red candle, which the red candle opens on the top and closes on the bottom. And in the same scenario about the opening and the range, okay? And then obviously we're gonna start looking at some examples at how we can come in and start using this. So without just looking at this candles in front of you, we want to be able to use the candle, right? The body of the candle, which is the session of the candle, how much volume there was in that session, right? And some Japanese say that the body is the essence of the price movement of the candle, and that this reflects a central concept about the power of the bodies. So by looking at the height and color of the body, we get an immediate visual clue where there's the bulls or bears who are in control as such. So candle charts will make market analysis faster and more efficient. Now, a practical application of the body is using its size as a barometer of the market's momentum. So we get a clue that the price momentum may be losing force as the real body becomes smaller. So the Japanese term for small body is a spinning top. The sizes of the shadows are not important. It is the small size of the body that makes the spinning tops important. So the tops are components of the candle formation, including morning and evening stars, haramis, hammers, and whatnot. Now, did you notice something about the candles in the doji example? They're any, right? Their designs are named doji. They represent the session when the open and close are the same or very close to one another. Doji and spinning top have implications as a reversal signal. So the evening star and the morning star, without knowing what the patterns look like or what they imply for the market, just by hearing the names, which do you think is bullish and which do you think is bearish? So the evening star, as they call it, which is the nickname for the planet Venus, which comes out before darkness is in, sounds like the bearish signal. And so it is. And the morning star then is bullish, since the morning star, the nickname for the planet Mercury, appears just before sunrise. So let's take a look at some candle formations. First of all, we have the hammer. The hammer is as in the market is hammering out a base. And the hammer candlestick pattern is formed of a short body with a long lower wick and is found at the bottom of a downtrend, right? A hammer shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up, and the color of the body can vary, but black hammer indicates a stronger bull market than red hammers. So if you see this hammer and the body black or green, you'll see that that is a strong indication of the bulls taking control of the market, of the trend. Or if you see a red, you could just okay, the bears are still in control. So the hammer's long lower shadow, this one right here, right? This can close at or near the high of the session graphically. And it graphically relates that the market sold off sharply during the session and then bounce back up, bounce to close at or near the session's high. So this could have bullish ramifications. And now this aspect of closing near or at the highs is why the hammer should have no or a minuscule shadow or upper shadow here, up here, right? So if there was a long upper shadow, this will mean the market closed well off its highs, which is an important criteria for the hammer. That the hammer is a bottom reversal signal, and we need a falling trend to reverse. But then we also have the opposite, which is the inverted hammer, which is a similar bullish pattern. The only difference being that the upper wick is long and the lower wick is short. So that's why it's an inverted. And inverted hammer has the same form as a shooting star and with long upper shadow and small body at the lower end of the range. And the only difference between the shooting star and the inverted hammer is that the inverted hammer comes after a decline. As a result, while the shooting star is a top reversal line, the inverted hammer is a bottom reversal line. Okay, and the inverted hammer indicates a buying pressure followed by selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests the buyers will soon have control of the market. Just as hanging man needs bearish confirmation, the inverted hammer needs bullish confirmation. And this confirmation could be in the form of the next day opening above the inverted hammer's body, or especially a close the next day over the inverted hammer's body. And the reason for the requirement bullish verification of the inverted hammer is because its long upper shadow gives the inverted hammer a bearish tone. On the inverted hammer session, the market opens on or near its low and then rallies. So the bulls basically fail to sustain the rally, and prices close at or lower or near the lows of the session. Okay, so there was a movement to the upside. They weren't able to close it up here, so it retraced back down lower. Okay, so you might say, why should negative action like this be a potential bullish reversal signal? Why should negative action like this be a potentially bullish reversal signal? The answer has to do with what happens over the next session. If the next day opens especially closes over the inverted hammer body, it means those who shorted at the opening or closing of the inverted hammer are losing money. So the longer the market holds above the inverted hammer's body, the more likely those shorts will cover. This will spark a short covering rally that could lead to bottom pickers going long. Okay, so this could fit up upon itself, with the result being the beginning of a rally. So if you ask me between the hammer and the inverted hammer, which one will have a stronger indication, I will say the inverted, because just if the criteria that the next day session closes above the previous one, right? Just like in this example, but they're both good. They're both pretty good. That's one thing that you know. Then we have the engulfing pattern. We have the bullish engulfing pattern, which is basically a major reversal signal with two opposite color bodies. And bullish engulfing pattern, the market is falling. Then a black bullish body wraps around and engulfs the prior previous red body. Little one right here. This shows buying pressure has overwhelmed selling pressure. A bearish engulfing pattern, right? And a bearish one will be the opposite way. Here the market is turning higher. A black body engulfed by a red body is a signal for a top reversal. So here we have a red body, a red candle being engulfing the black one, the previous one. So a black body engulfed by a red body being that signal over at the top reversal. And so this shows that supply has overwhelmed demand. There are some criteria for an engulfing pattern. Now, let's begin that for a bearish pattern, we need to have a clearly definable uptrend. Okay. Then for a bullish pattern, we need to have a downtrend for a bullish pattern. Okay. So we want to be able to see two candles on price, the engulfing pattern, right? One where we see the market moving higher, so marking the high of that movement. Then we have the red candle, which opens and engulfs the previous one, all right? And then we have the third, which exception is to the rule, is that if the first body of the engulfing pattern is a doji, so after an extended fall, doji engulfed by a very large black body could be a bottom reversal and an uptrend. And a doji involved by a very large red body could be a bearish reversal pattern. All right, so we have that. Now we also have a morning star. So the morning star is a bottom reversal pattern. Its name is derived because, like the morning star of planet Mercury, that foretells the sunrise. It presages higher prices. There are three candle lines comprising this pattern: an extended small body, an extended body. This proves that the bears are in control. This one right here. Then we have a small body that doesn't pass the prior body, right? These two lines comprise a basic star pattern, basically. But the small body means sellers are losing the capacity to drive the market lower. This is your signal. After such a long body, you see this minuscule small body, a small candle with a small body, that should tell you that, right? Those sellers are losing the capacity to drive the market lower. And then the concluding candle of the morning star is a black body that penetrates deeply into the first session, which is this one right here. The first session red candle. And this is the indication that the bulls have seized control. At this moment, you can tell, you sure bulls have taken control after this body, this candle, or just purges deeply into previous, penetrates deeply the body of the previous one. So that's the pattern for a morning star. And then we have obviously the evening star, which is basically the counterpart of the morning star. That name is the planet Venus. It appears before darkness. So we want to be able to take a look at that movement to the upside, right? Well, I want to move to the upside, and it's basically, if you ask me, is this not almost like the engulfing bearish engulfing. Well, yes and no. I think because we do want to be able to see an uptrend and then a candle that engulfs that last candle showing that uptrend. When we start and when we see an evening start, we see like a hanging man up there, like a little star. So basically, you can remember it this way, or you can remember it either way, like evening star or the bearish engulfing, by comparing it to a traffic light, right? So we first have the traffic light goes, from green, right, which is the black body, to yellow, which is the start, the warning signal. This is the second candle, is the warning signal. Then red, body confirming the prior trend has stopped. So again, evening star or the bearish engulfing, we have green light, which is marking moving higher, warning, yellow, right? Second candle, then third, and the third one is where you take your action on the third one, right? So in this case, in this scenario, or the evening star, applying what we just saw about the divergence, the confirmation on the S&P 500, if you see that the S&P 500 is moving higher and whatnot, then you see divergence, confirmation, and you see the VIX is rising, and you're in this candle, you could be sure to take a nice short position. All right, that's short for today's session of market breadth, VIX, short-term patterns. All right, wait until the next one. Have a nice day. Bye now.